Holy smokers, that ain't no dang jokers. Look at Elf on a Shelf stock here today, up over 6 percentage points. What's going on? That stock has all of a sudden had a massive reversal in fortune in regards to Elf. So what's going on here? Honest made a 4% plus move here today. That's what the S&P 500 read today. Dow Jones Industrial Average was down 142 points. The Russell 2000 was even red. So to see the Russell red and then see, stocks like Elf and Honest just taking off like that, like what the heck is going on there? So I want to speak about that at the beginning of this video. Then I thought I would react to the kind of this situation. One of my members of my private stock group, they sold half of their portfolio today. It was a big decision for them. And they did that, right? And everybody makes whatever decisions they want to make, right? And I'll kind of talk to you guys about my views on selling out of half your stocks, right? Or selling half your portfolio, or selling your full portfolio, and kind of my views on that in general, and like, why don't I do that, right? I think that's a good subject to speak about here. Why don't I ever? You never see me just like sell half my portfolio. Why don't I do it? So I think we'll discuss that at the beginning of this video. I think that's a really important subject after we talk about Elf and Honest. Then I'm looking forward to reacting to this one here, the Halftime Investment Committee on where the stock market goes from here. Looking really forward to sharing my opinions and perspectives there. And then last one we'll react to here is expect the S&P 500 to reach 7,000 by year end. And this woman's also talking about 7,200 next year. So looking very forward to reacting to that one. One thing only I need from you guys, and you know what it is. Please hit that like button. That's all I need from you guys. 7%. 7% is what the average is of people that hit the like button. That means 93% of the people that watch this video will choose not to hit the like button. I just need you to hit it. That's all I need from you. I can understand if you don't have a YouTube account and so you literally can't hit the like button because you don't have a YouTube account and you're watching this on a non-account or something like that. Respect. But if you have a YouTube account, could you please just hit a thumbs up? That's all I need, man. That's all I need. If you want to subscribe here to the channel, you can certainly subscribe. I think we're at 102,000 subscribers now. Not 100% sure on that, but I think we're at 102,000. So I appreciate each and every one of you for being here. Alrighty, first off, what's going on with Elf? What's going on with Honest? Why are these stocks moving up massively when the market's red? Well, here's the deal. You got to understand with the stock like Elf, okay? First off, was there any big news that happened in regards to Elf or Honest today? No. But in regards to Elf specifically, why does a stock like that just move 6%? You got to understand when you're dealing with Elf, you're dealing with a company that has what people would see as like a boring business model, right? They sell like beauty products, makeup, stuff like that, like big whoopee, like it's not the most crazy business model, right? But when you're dealing with the stock price of Elf, because Elf is a growth company, because they're doing big acquisitions, things like that, this stock is insane. Insanely volatile. Like it's not a normal like makeup company. Look at the moves of Elf over time, okay? First off, this was a big downfall of Elf here in this whole dramatic move, right? I want to get rid of Nvidia here, and I want to get rid of the S&P 500 so you guys can see these moves a little bit better and how dramatic they were, right? So Elf here is, we can call it $33, $34, drops all the way down to 21 here, right? Then goes from 21 in a very short amount of time all the way to 136. From 136 all the way down to 94 bucks. From 94 bucks all the way to 218. 218 all the way down to 158. 158 all the way to 212. 212 all the way down to 103. 103 to 140. 140 to $52. And I think the bottom here was actually, I think, 49 on Elf, by the way. Then we can say from $49 all the way to 130, right? And then the recent kind of drama in regards to Elf stock going down and then coming back. This stock's crazy, okay? It's just the way it is. Okay, this stock is a drama show. The moral of the story is Elf goes higher and higher as the years tick on, right? But the short term is it's a drama show. And I could take you all the way back to the IPO. It's been a drama show, right? Shortly after the IPO, the stock is around $31, right? And then when I bought my shares in 2019, I got those shares at $7, a little over $7 a share. So the stock's a drama show, okay? The business model might seem like it's kind of a relatively boring business model, but they have great growth. And since they're a growth stock, their stock price is crazy. And it's momentum. And you got to understand, A lot of people in the stock market are they're not buying ELF stock to hold that for the next 5 years. A lot of people that like to get involved with ELF stock get involved because it's the momentum, right? And they look at it as a very attractive stock to either short at particular times, buy put options against at particular times, or you get into some gamma squeeze situations. Next thing you know, people are buying calls left and right on it. They're buying the stock because it's going to go higher and higher and higher. So it attracts a lot of traders, a lot of momentum, a lot of swing traders, a lot of people that aren't thinking about ELF's next 5 or 10 years. They're not thinking about ELF as like this company is going to become a cosmetics giant. They're thinking about, is the next move for ELF from 120 to 150, or is it from 120 to 90? That's what they're thinking about. They're thinking about the next $10, $20, $30 with the stock price. They're not thinking about the next, we can call it $300 in the stock price. Okay? So you got to understand there's different people with different goals in the market, and with a stock like ELF, it's like an NVIDIA type stock. It's like an NVIDIA type stock where it just has these dramatic moves. And why? Because it has insane growth rates it's put up in the past, right? And then all of a sudden the growth rates will go away for a little bit, just like NVIDIA does. NVIDIA will post ridiculous growth rates for a few years, and then all of a sudden the growth rates drop down, and all of a sudden they're like, what the heck? The business is flatlining or it's going down, right? And then all of a sudden they come back with these great growth rates. Same exact thing happens with ELF, which makes for a dramatic stock, which those type of stocks, you've got to really have that gut to hold these type of stocks, right? I can hold a stock like ELF. It's no stress to me because, one, I've been doing this for like 17 years now, right? Two, I come from a family of gamblers, right? People that love to gamble on everything, like sports gambling and all that stuff. I witnessed all that since I was a small child. So I remember even going to the dog track with, my dad and wanting to place bets as a 5-year-old on, I would always want to bet the two dog. We went to Greyhound Park. You'd watch the Greyhounds race around. I'd want to bet the two dog to show. And that was like my risk reward, because then you just had to come in top 3, right? I felt like I was playing it safe rather than trying to bet one to win. So I witnessed this my whole life. So for me to be in this game and have to deal with stocks that are drama shows like an ELF that went from 7 to 200, then from 200 down to 49, then from 49 to 120, that's nothing. That's nothing. You get more experience in the market. It's just another thing. And then the other big part of it is when you construct a great portfolio of 15 or 20 stocks, you're not so tied up into every single stock's, move here or there, up or down, right? Like I got so many stocks to worry about all the time, so many earnings coming out, like whatever it is, right? Now, if you're all in ELF, you're on a roller coaster of emotions, because all of a sudden that stock's just tanking and it goes from 140 to 100 and you're like, oh my gosh, For me, it's just another stock. Like literally ELF's just another stock. Like ELF could go to 0 and okay. Like it's not going to happen, obviously, but it could. And I'll just be like, okay, like it is what it is. I got another 19 stocks that are doing just fine. So, you just got to let that stuff be what it's going to be. It's going to play out. It's going to play out. And as long as you understand, I think the biggest thing that also helps you get over this, right? This fear of like these stocks that go crazy and like the drama involved and oh my gosh, there's so much volatility and the up moves and the emotions. A big thing that can help you immensely is when you actually understand fundamentals of companies, when you understand income statements, balance sheets, running projections on a company. That helps you think longer term. It gets you out of this short-term mindset of stressing about, the stock's gone down a certain amount, up a certain amount in the short term, blah, blah. It gets you to think bigger. When I think about ELF, I run my projections for what I expect them to do in 2026, 2027, 2028, and 2029. And I run that all on 1000xstocks.com. And then I run the PE ratios. And then it spits me out what my bull case is for ELF, my bear case is for ELF, and my base case is for ELF. And based upon my projections that I run, I'm looking really good on ELF for the next 4 or 5 years. And so whatever happens in the short term, whether that stock's next $30 is up or down, doesn't matter. If you had call options, it matters. Or if you're really tied up into this game, emotionally, it matters. But, for you guys that don't know how to run projections, do this with source. This is the key to being a confident investor and knowing if you're getting a great deal on stock. Pin comment down there, click on that, fill out a form. Let's get you in my private stock group. Let's get you access to 1000xstocks.com. Let's get you out of a gambling mentality and into a state of mind where you're able to make confident decisions and not be like all over the place, like, oh, this is so crazy, right? Because I saw there was a lot of people freaking out about ELF stock just a few days ago, like, dude, ELF is up like a gazillion percent just in the past 3 months. Like, come on. Like, how much is ELF up in the past 3 months? How much is ELF up in the past 3 months? It's got to be a large number, right? Let's pull up a 3 month on ELF here. I don't need that. Let's see. 3 month for ELF. ELF's up 127% the past 3 months. And you had people panicking just a few days ago. I would see my YouTube comments, please talk about ELF. What's going on with ELF? ELF. Like, dude, the stock is up 127% the past 3 months. Come on. Like, and this is why you gotta take things to a higher level. Stop gambling in the market and start making confident decisions, and get out of the emotional state. The more emotional you get around this and don't know what you're doing, it's gonna cost you so much freaking money in terms of lost gains, and in terms of literally you're gonna lose money. You're gonna make very bad decisions in the market that you're gonna look back and be like, what did I do? And the thing is, there's so much money to be made in this market. The public counts at 1.1 million, 3 years ago. Today, the public counts at $3.64 million. There's so much. There's literally hundreds of thousands and millions of dollars to be made in this market. Ridiculous sums from upside and downside moves if you know what you're doing. But a lot of people choose not to learn this stuff. And I'm like, okay, do whatever you want to do. You want to just throw money around in the market and gamble? Like, that's your life. Do what you want to do. I'm just saying there's a higher level we can go to here and actually learn how to do this on the right way. But that's up for everybody's decision out there. Okay. No, look, there's an important subject today. Why don't you see me all of a sudden sell out of half my portfolio or my full portfolio of stocks, right? Why don't I do that? Well, this is an important subject because I see this all the time, including back in April. I saw plenty of people, in March and April selling out of their portfolio, especially after Liberation Day. Oh my gosh, that freaked people out bad, right? And they thought the stock market was doomed and we're going to have this, crazy crash. And we had a big downward move in the market. We had a major correction in the market, no doubt, from those February 19th highs to where we bottomed out the second week of April. And then we had a straight V-shaped recovery since then. And now we're sitting at right around new all-time highs in the market. So many stocks have gone up 40 to 127% in the past 3 months, right? Listen, you have two major issues. There's two main reasons you don't see me all of a sudden say, I'm selling half my portfolio, I'm selling all my portfolio. Two main reasons. First, it is such a tough call to make to call tops in the market. To call a top on the market, I would say there's less than a 10% probability you're right. Less than a 10% probability. It's so insanely tough. There's been plenty of times in the market over my past 16 or 17 years, I thought the market, was kind of toppy. And then you know what happened? It broke to a new all-time high, and a new all-time high, and a new all-time high, and a new all-time high. And then eventually the market would break. But at the end of the day, my timing was not right. There's been so many times I thought, but the difference is I don't then go act on those. I don't say, I'm going to go sell out of 50% of my portfolio. You don't see me say, I got 3.6 million in the public account. I'm going to sell 1.8 million tomorrow. That's a dramatic decision. So one, you're probably not going to be right on your timing. Second reason, just as important, if not more important, when do you get back in? When do you get back in? You want to sell 50% of your portfolio, 75%, 100%, a huge number like that. When do you deploy the capital again? When the S&P 500, let's say you're right. Let's say you called the top and a week later, a few weeks later, right, the market starts to downtrend big time. Okay, that's amazing. You pulled the 10% probability out. You called it. Okay. When do you start buying back in? Is it when the S&P 500 is down 10%? Does it even go down 10%? Is it when it goes down 15%? Is it when it goes down 25%? You know how often the S&P 500 goes down 25%? Not very often. Not very often. It's extremely rare. So do you wait for it to go down 35%? You know how often the S&P 500 goes down 35% peak to trough? Dude, you could be waiting 10 years for that to happen. So you're going to call a once in every 10-year event? That's legendary. Like, good for you. Like bravo, but just understand it's not sustainable. There's a reason The Big Short, the guy from The Big Short, he doesn't make these calls anymore. He's actually relatively bullish, and he just goes long the market, right? Because he's very of the understanding of like when he called the great financial crisis, Michael Burry and those type of guys, like that was a big call to make. And they were right. But you haven't seen them do anything since, right? And so it's tough, man. It's brutally tough. Like, it's just so much easier to play the game the way I play it. The way I play it, I buy stocks every single week, right? When I worked at Quick Trip back in the day, I would buy stocks every 2 to 3 weeks, essentially, right? Because, I'd need I'd have bills and rent and all those sorts of things. So I would usually buy stocks every 2 to 3 weeks when I worked at Quick Trip. It wasn't every single week, right? Nowadays, I buy every single week, but I'm in a much better financial position now that I wasn't certainly back when I worked at Quick Trip, right? So that takes a lot of the worrying about timing the market out of the game, and you don't stress about it that much. And so for a lot of you guys watching this right now, you need to be consistently buying. If you cannot buy stocks at least once or twice a month, look at your income versus your expenses, figure out where you got to make adjustments. Do you need to make more money? Do you need to get a better job, work a second job, start a side business? What do you need to do? Or do you have an expense problem where you're just getting that lifestyle inflation, you're just spending everything that's coming in, right? Which there's plenty of people out there that have that lifestyle inflation. So you got to be consistently buying in the market, and that takes out the stress of worrying about trying to time the market because you're always buying. I was buying in April, right? Additionally, another thing you do is always keep some cash on the sideline. I always got some cash on the sideline. The only time I get super low on cash is when we've gone through a major correction or crash in the market. If we have a crash in the market the next 6 months, okay, I got plenty of cash around. I'm ready to take advantage of that. So I don't need to worry about, trying to time in and out because I always got some cash around, right? And in better markets, my cash stacks a little bit more. And let's call it when the market's really in a bad shape and, stocks are getting slaughtered, guess what? My cash goes really low because I'm deploying. That's what happened actually back in April. Actually went relatively low on cash back in April because I was just flooding money in the market, right? And the other thing is you can take some profits here and there. You run your projections on a stock and the risk reward doesn't look that attractive anymore, right? Not because the stock went up so much, but because your numbers say it doesn't make sense to be in the stock the next 4 or 5 years, that's when you can start to cut some shares of stock. But listen, just because a stock went up a lot is not a good reason to sell. Let me say that one more time. Just because a stock went up a lot, just because the stock market went up a lot, that does not make it a good reason to sell. A good reason to sell is when you look at a stock on a valuation basis, you run your projections, and you say, damn it, this is going to be hard to make money in the stock the next 4 or 5 years because of the P ratio it's trading at and what a fair P ratio is, and based upon my revenue, my net income projections, this is going to be tough. That's when it makes sense to sell and take some profits. But not just because the market's gone up a lot, not just because the stock's gone up a lot. Like, guess what great stocks do? They go up. And you know what they do after that? They go up more. And you know what they do after that? They go up even more. And more and more and more. And then eventually they have a kangaroo period, and eventually they have a crash. But great companies, they go, like, NVIDIA, I could pull you up a chart of NVIDIA if you want. We could pull that up, and we looked at ELF earlier, but my gosh, let's look at NVIDIA. NVIDIA is a king of the stock market now, right? NVIDIA is literally the king of the stock market. There's no one that's a king over NVIDIA now at this point in time, right? And so we can look at NVIDIA since I got in the market around 08, 09, right? And it's hard to even see here, but even along this way, there was plenty of crashes in NVIDIA stock, right? Crash in NVIDIA stock there, 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 crash there, crash there. Plenty, there's been, since I've been in the market, NVIDIA's crashed so many times, it's ridiculous, right? And like I said, there was a bunch of crashes in here. You just can't see them because the chart's gone up so high now. But at the end of the day, since I got in the market, right, which was what, like fall 08, NVIDIA stock has a 78,000% return, right? And so you got to understand, if you own truly great companies, they're going to go higher and higher and higher and higher. Now, if you run projections on it and it doesn't make sense, fair to cash, right? And then maybe you get an opportunity after the stock crashes that then it makes sense to buy again. That's fine. That's fine. That's how you play this game at a higher level, okay? All right, let's hear these Wall Streeters.
I've been on that platform for a long time. To me, there's just too much that's potentially weighing on the broader market. It's things like tariff uncertainty, valuations that are already stretched, the consumer is starting to show little signs of cracks. There's a lot out there. I also don't see anything that wildly derails it. So I think within earnings season, we're probably going to have some big booms, some big busts in the individual company level. But I'll bet you that collectively we kind of come out with a meh. So when we think about this rally, you know, what are we up right now on the year? 6%, 7% for the 7%ish year to date. What if we end there? How wonderful would that be after years of plus 20% in 24 and 23? So that'd be wonderful. So I kind of think of the rally as let's just hope it sustains to this point and that nothing knocks the wind out of the sails. But I just don't see how with 9%ish expected earnings growth, with a 22 times multiple, with all the uncertainties out there, I don't see how we end up 14% on the year. I don't think we have another 7% in the second half.
I want to touch on your first point about the market being valuations being a bit stretched. S&P right now trading about 22 times. 5-year average is 20. Nasdaq at about 27 and a half. 5-year average is about 25 and a half. Weiss, I'm coming over to you. Do you see something derailing this rally? Do you see the markets just moving sideways? Does something lead us to moving lower? Again, we have that August 1st tariff deadline that Jenny was just alluding to. Is that potentially a catalyst for a downside move?
Potentially, but we've seen that will get extended. My bet is it does get extended.
So taco trades in play.
Yeah, but it's also, look, as I mentioned, I spend a lot of time in private markets, and deals never close when you want them to. I think the mistake they made, the administration, was advertising we're going to get this done quickly. Trade deals take years. So I think you'll see some agreements in principle. I think the positive that could be, you get a major deal with India. There's a word that could be coming. The EU, you hear that also, but that's less likely because so many head of cattle are herd. But that'll push the market up. It is a risk, though. If the administration draws a line in the sand with August 1st, then those tariffs come into effect, and then I think you see the market take some gas. But look, overall, you're coming to a seasonally slow period in September. That tends to get discounted earlier, and people just don't want to put new capital risk. I'm a bit more optimistic on the market only because I think the market's been valuation insensitive.
That's a good point.
When you and I grew up in the market, and you as well.
Valuations mattered?
Valuation mattered. Now
the good old days.
It doesn't matter at all. So it's purely
Is that because
momentum.
of AI? Are you saying that investors don't think it matters, or is there some other factor leading to valuations being less relevant?
It's not AI.
It's not AI. It's just you have a new cohort of investors that are used to markets only going up, and that may be the right thing to do. I mean, you want to stay invested. You don't want to trade markets. I'm happy to trade them because I've been doing it for so long. But the point is, what could derail the market, to your point, is I don't see the Fed easing in September.
Yeah, I don't either.
I don't see that happening.
So it's certainly not.
So listen, valuation still matters, okay? It matters on an individual basis. Every time you buy a stock, you got to be looking at that valuation, right? Secondly, very important, I state this here, okay? Listen, we're nearly 3 years into a bull cycle. When you're multi-year into a bull cycle, people do start to not really care about valuation because you're in several years of a bull cycle. Now, I know we've had plenty of, pullbacks or corrections along the past 3 years, but the market bottomed October 2022, and since then, we've been up and away, right? The corrections, blah, 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 but we haven't had any sort of crash since then. So when you're multi-years into a bull cycle, people start to care less about valuation. It's just the way it is, okay? It will come back, and it will matter, but it's going to matter after the next crash in the market. When I say crash in the market, I'm talking about S&P 500 goes down 30+%. When we have that, you know what's going to matter again? Valuation. It always comes back. And so now the question is, when's the next 30% downfall for the S&P 500? Maybe it's over the next year. Maybe it's 3 years from now. Maybe it's 5 years from now. I don't know. But eventually that will happen, right? And then valuation will matter again. And everybody's going to care so much about valuation. That will be a whole thing again. But when you're multi-years in a bull cycle, people tend to look the other way on valuation. That's just the way it is. And I've never seen it not be that way. And so, keep that in mind. But also do remember, listen, a lot of people believe Trump's policies and the Trump economy will be extremely pro-growth, right? And they believe that it's going to mean great things for company earnings. So the Trump economy really starts in 2026, right? All the changes he's making in 2025, it all is laid out and rolled out, right? And then 2026, we really start to see what is the Trump economy, right? In 2027, 2028, and in 2029, even though he won't be in office anymore at that point in time, still 2029 will still be the Trump economy because that will still be his policies. So if the Trump economy is really going to be this boom cycle, right, that some people believe, then valuations are going to come down immensely because the profitability of companies, especially the top companies, is going to go up immensely over the next 4 years. If that happens, right? And so that's a debate. And so if you believe that, then you should be willing to pay higher prices for stocks when it comes to a P/E ratio basis.
Then, like Christopher Waller is calling for the Fed to do. Christopher Waller, kind of highlighting his feeling that a cut should already happen, possibly in July. Do you make anything out of that? That Waller, who may also be a candidate to replace Jay Powell,
right,
is the person coming out and saying this?
Right. Consider the motivation, right? You always need to consider the motivation.
Yeah, consider motivations like canceling Colbert. Yeah, it's the most watched show, but it's economic. Look. While everybody's auditioning now, so everybody's going to be talking about that's a reasonable prospect, and even some underdogs for all about, let's cut.
True.
But the numbers don't give you the opportunity. We are seeing cracks in inflation, meaning going higher. So without the tariffs coming in. So I really think the Fed's on hold right now, and I think what Trump's actually done is he's put Powell back on his heels a little bit, and he's probably more resistant to cutting so he can keep the independence of the Fed. That's his interest. I think he's altruistic in that. So we'll see. But in the meantime, tariffs can hurt, worsening economic data can hurt, and we'll see from there.
All right, Kevin, they got the softballs. I'm going to come over to you. Are we at the risk of a bubble? Michael Hartnett.
The thing is, this is going to be interesting. I'm going to talk bubble top. What Jerome Powell has to do, at the next big press conference, he's just got to lay out that they're leaning toward potentially cutting in September. That's it. Don't cut here, but talk about that, based upon inflation data you're seeing, based upon economic numbers, it could make sense to potentially cut in September. Just kind of lay that out, and I think you'll be looking good because they'll get Trump off Powell's back then at that point in time. Because then Trump will be like, okay, they're going to start a cut cycle in September. So Trump will be able to lay off that. Jerome Powell will be able to sleep well at night, right? That's the best way to play. Because at the end of the day, I believe the Federal Reserve is going to cut rates in September. I'm fully of that belief. And I think Jerome Powell, if I could really get his opinion, I think he's of that belief. And I think a lot of the Fed members are also of that belief. We start the next cut cycle in September. You see inflation continually come in the twos. We haven't seen some crazy numbers because of the tariff drama, right? It's not showing up in the data. So at the end of the day, start the cut cycle and just lay that out in the press conference and boom.
America out with a note. A couple data points he's kind of spreading. Equal weight S&P versus the regular S&P at a 22-year low. Small caps versus the S&P at 25-year lows. Value versus growth at a 30-year low. In his mind, all signals U.S. economy is slowing and or U.S. equities are bubbling and we might be in a bubble. Your take?
Yeah, I don't see it as a bubble. 2023 was a better example of that microcosm where we really had 7 stocks and there was no breadth. Nothing else was doing any part of the heavy lifting. At least here, it's not just megatech. It's not just AI. We've got industrials. We've got financials weighing in. Well, I don't care about small caps.
To your point, though, the Mag 7, they're about half of the earnings growth for this quarter. So it's like 7 stocks doing a whole lot of the lifting.
Well, and we need them.
Yeah, but here's to be fair. Listen, okay? Those are the strongest stocks in the stock market, right? And that man just said, I don't care about the Russell, I don't care about small cap stocks. Yeah, because people are still very uncertain about the path of inflation, where the Federal Reserve is going, what's going on with the economy, all those sorts of things. So there's still kind of a lot of question marks there. So where do you go to hide out? Meta, right? You go to Apple, you go to Nvidia, you go to Amazon, you go to Microsoft, you go to the big dogs. Because those big dogs, what have we seen continually from the big dogs over the past 20 years? They come through. Regardless what happens, they come through. They can go through the great financial, they can go through the great financial crisis. They can go through Rona. They can go through Obama, Trump, Biden, Obama. They can go through, oh wait, did I say Obama twice? I meant to say Trump again, okay? 2 times Trump. They can make it through tariffs. They can make it through low inflation. They can make it through high inflation. They've proved this over the past 20 years. They're the most resilient, best companies in the world. And so at the end of the day, like, people feel very comfortable being in those stocks because guess what? Regardless what gets thrown at these stocks the next 5-10 years, they'll make it through to the other side and they'll emerge. The thing is, these companies don't just emerge to the other side. They are even stronger. These companies were even stronger after the Great Financial Crisis than before the Great Financial Crisis. Like if you look at where those companies were at in 2006 versus where those companies were at, when the Great Financial Crisis got over in 2010, they were a lot stronger. Look at them, prior to Rona versus after Rona. A lot stronger. Look at them before 2022 versus, now. A lot stronger. So even when they go through these dramatic time periods, 2, 3, 4 years later, they're so much stronger than they were before that happened. Which means you got to pay up. You got to pay up. It's the best of the best. It's the best of the best. And you're going to have to pay a price for that, right? And the crazy thing is, to me, you're not paying that big of a price. Like, it's not like Nvidia is trading at a crazy forward P given its growth rates. Meta's not trading at a crazy forward P given its growth rates. Neither is AMD. Neither is Google McDougal. Like, you're not paying some like ridiculous price. It's like, oh my gosh, I can't believe I'm paying this. No, not for these companies and how good their growth rates are.
Because if they don't deliver on earnings, then you can forget the markets being higher on a broader index basis because they're delivering so much of the earnings. But I think that the bubble story is probably a little bit stretched at this point because I think the earnings will deliver, Frank.
All right. Let me just pause. Can I just point out
sure.
The Netflix chart right now? I mean, let's take a look at the Netflix chart. Shares are down more than 4.5%. They beat on the top and bottom line, improved their outlook for the second half of the year, and this stock is still going low. Are we at risk?
Who called that? If you follow me on X, my X is always linked in the description area. I could have made some money on some put options, by the way. It's always linked in the description area if you don't follow me on X. What did I post yesterday before the Netflix, I posted like an hour before the Netflix earnings came out or so. Did I already go past it? Maybe I already scrolled past it or so. Netflix. Oh, right here. I said Netflix is reporting after the bell. Everyone's expecting the stock to boom when earnings come out due to Squid Game, blah, blah. Numbers should be great. The most stock market thing the stock market could do is have the stock go down after earnings come out. And sure enough, that's exactly what happened. That's exactly what happened, right? Like the stock had been red hot. Everybody was expecting the numbers to be great. Everyone's expecting the stock to go higher. When everyone's expecting an outcome in the stock market, what do we know a lot of times happens? Goes the other way.
We see some of these mega cap tech names, and Jenny, feel free to jump in, that we could see the same setup, that a Microsoft, a Meta, and Amazon, they could beat expectations, give good guidance, and still move lower because it's just simply not good enough. Because to your point, valuation, even though we have this, what you call a new cohort.
But I think that's the thing. What's Netflix down right now? 2%?
It was down 5%. But
yeah, but then I thought I saw it less. Whatever.
Down 4.7.
It's just not that much. Right? So, and I think when we think
Given
about
how
the
much it's up,
valuations
yeah,
of the Mag 7 overall.
Dude, here's a crazy thing. In the 2022 crash, I never, ever bought Netflix stock before 2022, right? And I've been in the market so long, I always looked at it. I was always admired the company. I always wanted to buy it. Finally got an opportunity, and I bought some shares in 2022. You know how much I paid for those shares? $185. $185 I paid for those shares. It was like summer of 2022. And Netflix, is $1,200 plus now. By the way, I made I think 30 or 40% on it, and I sold. Buy and hold the great ones. Buy and hold the great ones.
Right now, I'll call them stretched.
Unless the valuation's ridiculous, which it wasn't really at Netflix at that time. It wasn't like it had some insane valuation that was just ridiculous, and it was didn't have that. Damn.
A little.
Damn.
They're not stretched a lot.
A little.
In the past, I've kind of freaked out by how stretched the valuations are, and that's just not the case. So for us, right, we have our disciplined growth strategy where it needs a 5% or better free cash flow yield to get in there. Apple's on the short list. Google's kind of on the short list.
Meaning you're going to short it?
No, on the short list of potential things that we could buy. But the reason being, the cash flow's there.
Look at Mr. Short Hills Capital. Look at him. Wow. You get him around some different individuals. This is what we need to tame Mr. Short Hills Capital. You put this Jenny next to him. You must love Jenny. Like, all of a sudden, he's chill. He's chilling like a villain, right? You put those other two guys next to him. Oh, man. The one guy looks like he, could be a manager at an Italian restaurant in New York City, right? And then the other guy that looks like just annoying. Man, you put those two guys next to him, he's ready to fight. He's always high-feisty. And then also you got, Scott over there. And Scott, I think, has an agenda against him as well. But, man, you put Jenny next to him, Mr. Short Hills Capital being all smooth.
Short list.
Meaning you're going to short it?
No, on the short list of
Smiling,
potential
laughing.
things that we could buy. But the
Wow.
reason being,
What
the
a
cash
change.
flow's there, the valuations are reasonable. So when we look at the Mag 7, my thought collectively
Cheers.
is maybe they plateau. Right, but I don't see that in frothy
Look at
territory.
it this way. The stock's doubled over the last year.
Which one?
Netflix.
Oh, okay, sorry. You're coming back to that. I thought you meant Mag 7.
We're going to talk about it later. I'm just saying, is this an example of some of the risk that comes in earnings season where a company does better than expected, they raise their guidance. Generally, that makes the stock
I see
move
where you're
higher.
going.
No, this is idiosyncratic, right? This is a story like no other story out there. Now, take your question a little further. If you see Google, Alphabet, if they miss because of cloud, and then Microsoft misses because of cloud, those factors, that's more of a market story, that growth, because that feeds into so many other elements of the market. But no, I don't think I think people are reasonable. And by the way, Netflix has sold off so many times on earnings that if you sold because of that, then you made a mistake.
Boom.
5% here is nothing. It's bupkis. It don't even focus on. But here's what I'd say. If you take a look at a number of the firms that came out and raised their price target in advance of it, and the money that piled in, and now to sell in the news from the traders that got in, they're getting out.
Yeah, here's a big thing you guys got to expect for this earnings season, okay? Listen, there's going to be some stocks that report very good earnings. They're great companies, okay? And the stock is going to go down. And that's okay. And you've got to be okay with that. Don't get frustrated. Just understand that happens sometimes. Company comes out, good number, beats, good guide, good conference call. And I don't know, one little thing happened out of the 100 things and stock sold off. Fine. Sometimes stocks run so heavy into earnings, like there's nothing a company could do to have that stock go up more. Like it's just impossible. It's fine. Like, you got to be okay with that. It's a hard pill to swallow. But it is a pill that needs to be swallowed.
Everybody's feeling good. You're not worried about any froth in the market. In fact,
I'm not feeling good. I never feel good.
Me neither.
I always have concern.
You look
about
good,
the
though. I like the
market.
pocket square. You and
If
Kevin did
you
a
don't
great
have
job.
concern and worry about risk in the market as professionals, if that's not your primary concern, then you shouldn't be in the business.
All right, let's touch on something really quick. This is an ETF I wasn't that familiar with before today. The Next Generation AI U.S. Sentiment Leader Index, the ticker's BUZZ. Note from BTIG's Krinsky saying he's seeing more and more signs of short-term froth in the market. He's pointing to this ETF up 45% in the last couple weeks, 29% above his 200-day moving average. And some of the top holdings are some of your holdings, Kevin, Robinhood and Palantir. Are you worried that there's a risk of unwinding a lot of these names and that the momentum may be slowing down and possibly moving in the other direction? In all fairness, though, big gainers, similar to Weiss's point, these are stocks that have big run-ups. We're worried about some of that momentum unwinding itself.
Exactly. I mean, Palantir's up a trillion, bagillion, zillion, dillion, rillion %, like in the past year. Like, let's pull up good old Palantir and let's see what. Oh my gosh. 436% gain in the past year. Four flipping 436 flipping flapjacks. Are you kidding me? Insane. Who used to say this? Insane in the membrane. Who was that?
It would be very difficult if you think of a coiled spring for these not to give up something
Right.
at some point, because if you look at Robinhood in particular, which is one of our favorite stocks in the growth portfolio, Frank, in early April, this thing was trading in the low 30s. and now I don't know where the chart is, but probably close to $110 a share.
Yeah,
that is an incredible run, but I'm not ready to bet against it because they control the ecosystem of the young person. Roblox, American Express, Robinhood. We love these because of where they're embedded. Palantir a little bit different, but if you look at how they're expanding away from just being purely dedicated to government contracts, how they're getting to the private sector, I'm not going to be the person that's shorting these or betting against them. Not yet.
Yeah, the thing with Hood, here's the deal. If you want to know when to bet against Hood, right? Or if you're wondering when to sell Hood stock, right? Oh, look at this guy. Look at this guy running in my neighborhood with no shirt on. He's not in the best condition, but respect. I never see anybody with cojones big enough to run in my neighborhood with their shirt off. Everybody thinks they're too rich to run with their shirt off. It's like, dude, take your shirt off. Be a man. What's wrong with you guys? Bunch of freaks. Here's the thing with Hood, okay? If you want to know when to bet against Hood or when to sell that stock, here's when you do it. When the market sentiment on the retail trader investor side shifts and goes bearish, that's when you need to be long gone out of Hood, and you might even want to bet against it. We haven't seen that yet. At some point in time, the retail trader investor will say, you know what? Enough is enough. I think I'm taking profits. I'm not feeling good about the market. I'm out. That will be the time when you know what you go ahead and say, because then what's going to happen with Robinhood numbers is their assets under management is going to peak and will actually start likely going down after that. Because then the market's going to also shift and likely start going down. And then you'll start to see even weakness in things like Bitcoin, which Bitcoin's a huge beneficiary. Like Hood's a huge beneficiary of Bitcoin. And you'll start to see options activity slow massively because people won't be as bullish on the market. And then also people that are still on the retail side that will still be trying to play those last lemon squeezes, that are playing options, they'll start to lose on options. So instead of making money on call options, they'll start losing money, which is not good and can actually make assets under management go down. So just keep in mind that's all going to play out. But when is that? When's a retail trader say, you know what? I'm not feeling good about this market anymore. I don't know. Maybe it's end of this year. Maybe it's in 2026 at some point in time. Maybe it's not till 2027 and 2028. It's another, goes back to the whole time in the market thing. That's a tough bet to make. But at some point it will happen, and that's when you go against Hood.
By the end of next year, Bitcoin, 150,000. Wow, you're a wild woman. This is Marianne Bartels is here with Sanctuary Wealth. You are not afraid. You're fearless.
She's not afraid to take a stand.
After 40 years of being in the business, Joe, I've developed some confidence in the analysis that I'm able to do. And, you were right. You said that, we need growth and AI, and I think it's coming. I think it's going to significantly impact corporate earnings, productivity, and it's going to show up in the equity markets. And Joe, it's not just a bull market here. It's a bull market globally. You're seeing European markets break out. I think you're going to get the Japanese market to break out. It's a global secular bull market driven by all this new innovation, from AI to blockchain to crypto to Web3. And I don't think all of this is yet priced into the market. And you can see we're already in a summer melt-up. The market is not positioned for this yet.
That was something big just hit me. It was an asteroid. No, okay, here's the big thing that just hit me. I was just thinking about this because I was thinking about in terms of the market. And, I was thinking about you always got to think in regards to stock market. Is there a better alternative? Is there somewhere better to put money, right? We know treasuries, you can get 4% in treasuries if you want to be there. High yield savings account, you might be able to get something in the 3s. Even getting in the 4s is tough now at this point in time. And then I thought about one of the biggest money sucks away from the stock market is what? Real estate. One of the biggest money sucks. Think about me, for instance, right? I got a new home being built. It's a very expensive home. So every few months, as the process goes along, I have to part with hundreds of thousands of dollars, right? Boom, boom, boom. Less money to go in the market. But think in the respect of no one's buying new homes. Like home sales are dead. Like we've been for the past year or so. Like you could look at home sales numbers. It's like great financial crisis type volumes. No one is moving right now. It's hard to even, like, if you got some nice furniture to sell and you want to list it, it's hard to even find people to buy it because no one's moving. Everybody's just staying put in the same apartment they live in or the same house they live in. Real estate investors aren't buying anything right now because they don't think there's a good ROI out there. So if you make money, your money starts to stack and it's not going into real estate, which is usually one of the biggest money sucks away from the stock market. So when the real estate market actually comes back, which, might still be several quarters from now or might be a year or two from now, right? It's going to suck money out of the stock market because I see it all the time. Like I see private stock group members, regularly. I've been around the private stock group now for 6-7 years or whatever, right? I've seen plenty of times where somebody says, I got to sell, it hurts me to sell this stock I have, right? But I have to sell it because I need it for the down payment on the new house I just bought for my family, right? Or for myself. It happens all the time. Or they buy in a condo or something, or they buy in a real estate investment property, so they sell out of a position they have, or a bunch of stocks, and they have to sell 20% of the portfolio to cover the down payment on the new condo, the new house they got. I've seen that a trillion times in the private stock group, right? That happens on a regular basis, but that's when homes are moving. No one's moving right now, so then people's money stack, and they're looking at it and they're like, "What am I going to do with it?" Stock market. That's where you get the ROI. Even this year with all the drama that's gone on, they were just showing it. The S&P 500 is up like 7% this year. If you've been in a treasury this year, you know how much you've made so far? About 2%. So you could have been in a treasury making about 2%, or you could have been just in the S&P 500 made 7%. And then if you were in good stocks, you're up probably 30 to 50% so far this year, if you're in really good quality stocks. Versus 2% in treasury, versus about 1.5% in a high yield savings account. And real estate's a no factor right now. So someday people will want to buy real estate investment properties again. Someday people will want to move again. And people will start buying homes and condos, and there's going to be a lot of action. And that's going to suck money out of the stock market. But it's not today. It's not today. But it will eventually happen. But the stock market, there's no doubt, it's been a big beneficiary of this.
A point that was made by Kevin Warsh yesterday, I don't know if you saw it, Marianne, that there are powerful disinflationary forces coming from AI. And if you think about the internet, none of us had any idea what that was going to usher in. And if this is more powerful, what happens with AI than the internet, think about in terms of it maybe not just disinflation, but the amount of, I guess if you have growth deficits and debt becomes, less cumbersome, and therefore there could be perhaps a secular disinflationary trend from technology, which is pretty exciting. But we could have lower rates and not worry about it.
And I agree with that. I do think rates are trending down and can go much lower than people expect. Right now, we're in heightened fear that tariffs are going to bring inflation. And I think over time, especially trending into next year, we can get rates down. And that's going to be another stimulus for risk assets, for the equity market, for the crypto market. And then maybe finally we can get something moving in the housing market if we can get rates down.
Marianne, you didn't start the year at 7,000, did you?
I started the year at 7,200. And when tariffs hit...
Yeah, go ahead.
Another factor here that I think is important we address, right? We just talked about the housing market, is what is another big money suck away from the stock market? You know what it is? Anything that people buy that's like, I call it, I feel good about myself, I feel good about my financial situation purchase. You know what things like that come to mind? Boats, ATVs, jet skis, all that stuff. All those businesses have not been in the best place the last few years. We all know that, right? And, as somebody that knows people that run different business models like that, like those businesses have not been the business models to be in the last few years. They were really hot kind of during the Rona, right? And especially after the stimulus money. So like the back half of 2020 into 2021 and even the beginning of 2022, those businesses were hot. Then interest rates went up huge. Everybody got hit by inflation. Obviously, those business models have not been the best the past few years. But those are sorts of purchases that sucks money out of the stock market too, right? But people just haven't been making those sorts of purchases because they don't feel necessarily great about their financial situation. So they, like, you buy a freaking boat, dude, that's like one of the most confident, like, pump your chest like moves you can make. Like, you bought a freaking boat? Are you kidding me? You flipping my flapjacks here? You bought a boat? Like, you go buy some jet skis, you go buy some ATVs, some side-by-sides, whatever. Dude, that's like, you know, you got to feel really good about yourself to be making those sorts of purchases. And those just haven't been the play the past few years, right? And so that's another thing that people will say, you know what, I'm not buying a boat right now, but I'll go buy some stocks. So the thing that's interesting here is you could actually have, let's say the economy actually strengthens over the next few years, the housing market comes back, right? These sorts of purchases come back. That doesn't necessarily mean the stock market's going to boom. You can see the stock market kind of be blah, while the economy is actually, you know, let's say strengthens a lot. The housing market strengthens a lot because money gets sucked out of, you know, let's just call it, that gets sucked out of the market and goes into a lot of these things that are big ticket purchases. Like, you know, how many people have been going out there to go spend $20,000 in new furniture? There just hasn't been a lot of that the past few years, right? Look at RH's numbers, you know, and that's the high end. RH's numbers have been pathetic the last at least 2+ years now at this point in time. Pathetically bad. And then they cater to the top 10% of income earners. They cater to the top 10% of the wealthy. And even when you cater to them, your numbers are still trash. So, you know, like, that's the sort of economy we've been in, but people still stack money, and so they put it in the market. So it's going to be an interesting dynamic. I'm really looking forward to watching this next few years in the market because there's a potential that the gains in the S&P 500 and Nasdaq, you know, 2026 through 2029, it's a potential they're going to be very limited. Now, there's going to be certain stocks that absolutely go beast mode, but there's a potential where the stock market, you know, is kind of blah during that time. And there's a potential you actually have a much stronger economy, a much stronger housing market than you have right now. And people will look at the stock market and be like, it's not really reflecting. Remember, if you look at the stock market and the economy over the past few years, people have said, man, the stock market's doing amazing, but it doesn't feel like the economy's doing amazing. It feels like the economy's just kind of like blah. But yet, look at this freaking market. Like, you would think, based upon looking at the stock market, you would feel like this is the strongest, best, greatest economy in the history of the United States, right? Like, it can't be beat. Like, everybody's got to be feeling, you know, the best they've ever felt. It doesn't feel like that. It feels like the economy's okay. Like, that's just what the vibe is. Like, the economy's okay, but it doesn't feel like the strongest economy, right? Like, the two strongest economies, I would feel like a consensus, like everybody felt like those economies were really strong. I think the economy we had prior to Rona for those few years, I think that felt really strong. Like, there was a building of the economy, then Trump came in with like the tax cuts and those sorts of things, some deregulation. It felt like that economy from kind of like, let's call it through 2017 through 2019, it felt like that was an overall very strong economy, right? And then the other economy that felt really strong was like 2021, but it felt actually too strong. But that was because, you know, the reopening of things, so that re-energized businesses and business spend, and then you had the stimulus money and all that. So like, that was artificially too strong, basically the 2021 economy, let's call that, right? But does the economy in 2025 feel like that? It doesn't. It feels okay. So it's going to be a fun next few years to watch how the market does versus how the actual economy does 2026, 2027, 2028.
So when tariffs hit, we did mark down that if we did go into a recession, those targets wouldn't be hit. But since after we went down 20% from the tariffs, we've been raising our targets ever since. And so I'm comfortable getting to year end at 7,000. And I think in the first quarter of next year, we might even be at 7,200. What I learned is that I shouldn't have changed my forecast.
Right.
The thing that could screw some people the worst is, let's say there's this consensus, like the economy really starts to improve 26, 27, like people start to feel great about the housing market, like spend, and it just feels like the average person just feels great. The average middle class person feels like inflation's under control, interest rates go lower, they feel like the jobs market's good, small business owners, get back to making, best profits they have in, long time. Let's say that happens. Like, I just wonder, I could see valuations on the market actually coming down. I could see that being a potential where the P ratio looks like elevated on the market, but I could see it coming down because let's say less money's going into the stock market, right? And we have a dynamic where earnings keep increasing, then P ratios will actually come down and come down considerably for the market. And so the market will actually look cheaper and cheaper as it goes along. But I could see some people getting screwed bad. And how I could see that is, let's say, a lot of people have been anti the stock market the last few years because they felt like the economy is not good or whatever, right? Or all the drama going on. Imagine people, because the economy starts to feel better, the housing market, all that, there's just more good vibes. Imagine people are buying heavy in 26, 27, 28, just the market in general, the S&P 500. And then imagine they hardly make any money over those next few years. And then imagine after that, you actually get a bad economy. Like there's a crash that happens. Let's say things get too good, like people take out way too much leverage, something like that. Like that would be fascinating, right? And then, man, a lot of people would be very jaded about that. That's all I'll say about that. And that's why you just got to stay invested. That goes back to the whole time in the market beats time in the market, because you don't know how the market's going to react. You don't know how it's going to react, but you got to be in it, right? You got to take advantage of opportunities out there. All right, guys, appreciate you joining me as always. Thanks so much for being here. If you're looking to apply to join private stock group, private wealth group, get access to thousandxstocks.com. Exclusive weekly videos like the one I posted today for my private stock group members, a 20+ minute video discussing some very important subjects. Pin comment down there, click on that, fill the form, see if we can get you access to all of that next week. Much love and have a great day.